What is going on, traders? We need to talk about Robinhood stock. If you guys are planning on trading this or already have positions in it, you'll definitely want to pay attention even more. There is some bombshell news that just came out about the shares that Robinhood pre-IPO investors hold. They are going to be selling off a lot of shares. By a lot, I mean almost a quarter of the public float. There is also some crazy options activity coming in for Robinhood stock, telling us potentially where investors think the stock is going, or at least where they're betting the stock is going. These are likely the reasons that Cathie Wood, who has been adding Robinhood since it IPO'd, did not add more shares yesterday, even as it shot up into the 80s, finally settled at $70.39. So I'm going to get into all of that for you. I'm going to break it down, and I'm going to be showing you how I'm trading Robinhood stock going forward, even amidst all of this news that I'm about to break to you. But before I get into it, welcome back to The Traveling Trader, your source for non-BS, regular, concise market updates. If you get anything out of this video, leave it a big fat thumbs up just like this. Leave it in the comment section below. Let me know if you have a position on Hood and where you think the stock is going. Without further ado, let's get right into it. So ever since Robinhood IPO'd on July 29th at $38, a lot of analysts and stock YouTubers were saying how Robinhood's IPO is going to fail. It did have a slightly down day that day, opened at 38, closed at 34.82, and I think that they thought that was a precursor of things to come because Robinhood is seen as the enemy of the GME and AMC revolution. They didn't think that Wall Street bets would jump on board and try to pump this IPO into oblivion, which actually happened. If you look at the Wall Street bets mentions here on QuiverQuant, you can see that Robinhood far outweighs AMD, SPY, AMC, Moderna, GME, SoFi, etc., etc. This top line right here is actually Robinhood. It seems that most folks forgot that Wall Street Bets at the end of the day is a place where people want to make money as well. All right, so let's get into the news right quick. So Robinhood shares are down almost $10 pre-market as of the time of this recording. And the reason is because stockholders have filed to sell up to 98 million shares over time. Now, these are shareholders that existed pre-IPO. They are pre-IPO investors. They saw the insane stock run up yesterday and they just could not resist. The problem is that Robinhood's public float, the shares that are available to the public to trade, is only 427.5 million. That means that these insiders or these investors are selling almost a quarter, just under a quarter of Robinhood's public float. You can't dump that many shares out on the market, even though they're not doing it at once, they're doing it over time as not to affect the stock price drastically. But news like this is going to affect the stock price drastically. And you can't dump that many shares or announce that you're dumping that many shares without the price dropping. Now, the real price action kicked into gear when Robinhood started offering options. When the monthly options opened, you saw a swath of call buying. The 70 calls, for instance, have almost a 14,000 open interest, meaning that there are 14,000 open contracts for Robinhood at the $70 strike price. For an IPO, this is actually a lot. And because of the volatility, we saw the options premium spike. When volatility goes up, option premiums go up. So you can see that for the $65 call, which is a relatively cheap stock at $65, for a $65 call, you're paying almost $1,500. Now, just for comparison, look at Pinterest, which is priced similarly to Robinhood, and look at these option premiums for the same expiration. For the near the money calls, you're paying $235 as opposed to over $1,500. But here's the rub now. We are actually seeing more puts open than calls. Puts obviously are bearish bets. This is something we did not see with AMC and GME. Obviously, people were buying puts, but calls were outweighing puts by a lot. Now, this is very dangerous if you are going to play puts, and I'll explain it in a second. But the 10-day moving average of call volume is also on a downtrend, something that we did not see with previous stocks that were supported with Wall Street bets. So far, this support of Robinhood looks very temporary. And if I were you, I would look to lock in profits as soon as possible. Yes, the stock can run up, but right now we're talking about the risks starting to mount, and the risks could outweigh the benefits. It does not mean that if you diamond handed this thing, you could not make a ton of money. Who knows? Robinhood could maybe blast to $100. But as I said, the risks are mounting. It's not like the risks are staying static. Another interesting fact is that Cathie Wood actually stopped buying Robinhood even as the price went up yesterday. They initially added 3 million shares to the fund. We own Arkk, so we gained some of that exposure as well. But she likely saw that the insiders were selling almost 100 million shares, and the fact that there are a ton more put options than call options at the moment. One other minor point is that even on Wall Street Bets, you could see that the put mentions outweigh the call mentions at the moment, with 396 put mentions versus 216 call mentions. Also, the regular mentions for Robinhood are down almost 50% from yesterday's volume. All right, so why wouldn't I buy put options here if I think that Robinhood is going to drop? Well, I did a video as to why I don't buy naked options in general. Yes, there are times when I like to YOLO them. There are times when I do like a little bit of a gamble, a little bit of a risk, but they are not part of a consistent money-making strategy on a week-to-week basis. That is what spreads are for when we're dealing with options. Same thing applies to buying puts. Now, the reason that it's dangerous here is because implied volatility is at an all-time high for Robinhood. And that is why, again, we see these option premiums increase. This also applies to puts. It doesn't mean that the call options are the only options that have an inflated price, but puts do as well. You can see the $65 put will cost you almost $1,200. Now, we saw this with AMC and GME, even in my own portfolio. When I saw that the GME price was dropping, I'm talking about back in January, February, then I bought puts. Now, I was successful at it the first go around, but then the implied volatility went up again. The reason that's a problem is because if you buy puts and the stock price goes down, but implied volatility goes down as well, then the options premiums take a hit and basically they cancel each other out. Whether you buy calls or whether you buy puts, you do not want to see implied volatility drop at the same rate that the stock is moving in your direction. So if you bought a put and the stock price goes down, but implied volatility goes down at the same rate or sometimes even greater, you can even lose money even though the stock is moving in the direction that you intend. So what is a better play here with Robinhood? Well, aside from day trading it, which I've been doing, now I do have a day trading video and the day trading setup that I use on Thinkorswim with the 1-minute chart at the top, the 5-minute chart at the bottom. I will link that video here. And I've been day trading Robinhood, really using an old school VWAP strategy, which is this purple line. When it pops above VWAP, then I buy calls or buy the actual stock itself. Now, even if you're not a day trader, go ahead and check out that video anyway, because you always learn something. However, if you wanted some options exposure to Robinhood and you wanted to play a bearish position, as opposed to buying puts, what I would do is sell call spreads. Because the options premium is so high and the IV is so high, when you sell spreads, that is when you take advantage of dropping IV. If you sell option spreads, whether you sell a call spread or a put spread, I'm talking about vertical spreads here, and you do that in a high IV scenario, when IV drops, you make more money because you sold a spread or you sold the options when IV was high. Now IV is dropping and the value of the options that you sold are lower, but you sold them for a higher value. So when you close them out, you buy them back for a lower value. So you take advantage of that IV drop. So what I would do is sell something ridiculous, or what seems ridiculous at the moment, like the 80-85 call spread. If I sold this vertical here, I could sell it for $1.25 or $125 per contract. Now, if Robinhood remains below 80, I get to keep that entire 125. The danger becomes if Robinhood closes at expiration above 85, my max loss is the width of the spread minus what I got paid to take the spread, which is $1.25. So my max loss is actually $3.75. Now, this all depends on the chance that Robinhood will expire above or below 85. Obviously, you can go even higher if you have a little bit of trepidation here, but I would much rather sell call spreads than buy puts here, because again, even if you buy puts, you could still lose money if the stock price drops, if IV drops at a much more drastic rate. And if you've always wanted to learn how to trade options, you wanted to peek a little bit behind the curtain, but it just always seemed like this black box of opportunity that everybody else was taking advantage of and you couldn't learn it on your own, I put together a course. I spent 100 hours putting together this course. The link to that beautiful course is below. Check it out if you want. Obviously, you can always learn to trade options on your own, but I put a course together that is consistent and concise. So check it out if you like. Sign up if you want access to all of our trades. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.